Global Wall Street gathers in Washington with a focus on higher rates, shaky banks, and whether the world's two largest economies can work together. This is Bloomberg Wall Street Week. I'm David Weston. This week, special contributor Larry Summers of Harvard on whether we're headed for a soft but slow landing after all.
I don't see inflation as on a secure path down to the 2% target unless the economy turns over a bit.
Glenn Hubbard of Columbia on whether we're headed for a credit crunch, and Sonja Gibbs of the IIF on the plight of zombie companies.
Higher rates are going to cause a lot of pain, and particularly for these zombie firms.
Washington hosted the annual meetings of the IMF and World Bank again this week with a focus on threats to global growth. Treasury Secretary Yellen insisted that things didn't look all that bad.
I said that the global economy was in a better place than many predicted last fall. That basic picture has remained largely unchanged.
Though IMF Chief Economist Garancha warned that questions about the banks could be a drag on the global economy.
The risk that banks are going to look at the outlook, they're going to look at their bottom line, and they're going to be a little bit more prudent in extending loans going forward, and that could weigh down further on economic growth.
And geopolitics, particularly the tensions between China and the United States, the world's two largest economies, could make the difference, as acknowledged by Treasury Undersecretary Jay Shambaugh.
We obviously need to be able to work together.
U.S. CPI numbers came out showing that inflation is still with us, but it appears to be moderating.
We know that prices are still too high for so many things across the economy, but certainly we are looking for this downward momentum.
The markets took all of this, put it together with somewhat weaker retail sales numbers, and came out slightly higher, with the S&P 500 adding 0.8% and the NASDAQ up almost 0.3%, while the yield on the 10-year was up 13 basis points to end the week just over 3.51%. For their thoughts on what we learned this week, we welcome back now Kristina Hooper, Invesco Chief Investment Market Strategist, and Saira Malik. She is Chief Investment Officer at Nuveen. So welcome to both of you. Great to have you back with us. Saira, let me start with you. What did we learn this week, and specifically about where the economy is headed, maybe more importantly what you think, what the Fed thinks? Is there evidence, in fact, in the CPI and on the numbers that, in fact, we're getting our arms around inflation?
Well, we learned that progress is being made on the war against inflation, but economic damage is yet to be seen. We had two data points for the bulls and the bears this week. For the bulls, CPI and PPI both moderating. Great to see sticky areas like shelter starting to become a tailwind. But for the bears, hawkish Fed speak and also negative retail sales for March. That's 4 out of 5 months there. And that concerns us that overall, we still have economic downside ahead of us, perhaps lower earnings going forward, and market valuations with the S&P above 4,100 likely has a tough time going 4,200 to 4,400. If it gets to that level, I think we just stay in a trading range and then go back down from there until we clear the decks on what we think is likely coming up, which is a mild recession.
And the Fed, 25 basis points in May. What do you think, Saira?
We think the Fed is one and done, one more 25 basis point rate hike in May. But what we haven't seen yet is now 13 months ago was just the first Fed rate hike, and we have not seen the effects of monetary tightening through the economy. We did just see it recently with the banking system. I think there's more to come in terms of how higher interest rates are going to impact, for example, the consumer, tighter credit conditions. That's going to impact the economy, which is why we're expecting that slowdown going forward.
Kristina, one and done?
No, I don't think the Fed is going to hike rates again. I think the odds are increasing that they won't, and I think that is the right decision. The Fed has already done enough, and I do believe that they're going to be relatively comfortable with the pace of inflation, especially since we've seen progress made in services ex housing, which is the component of inflation that the Fed is laser focused on.
Are they not going to hike rates, Kristina, because, in fact, we're headed toward a recession? They see that.
They're not going to hike rates because inflation is coming down at an appropriate pace that they're comfortable with, and they're not going to hike rates because they know that there are lagged effects of monetary policy. So we haven't yet seen most of the damage that has been done by the aggressive tightening cycle.
But no recession, you think?
Well, I think that there is a pathway. It has narrowed, but there is a pathway to a semi-soft landing. If we get a recession, I think it's going to be mild.
Saira, recession, no recession?
We're in the mild recession camp, and the reason that we think the Fed has more work to do with raising interest rates is because they've been clear that their mandate is 2% inflation as a target. I don't think they're going to take their foot off the gas until we get closer to that number, and we're just not near that yet. The other thing we're concerned about is earnings. Now, coming into first quarter, it was nice to see that earnings estimates actually were cut to a higher amount than usual. So Q1 earnings maybe come out all right in terms of revenue growth. Margins will continue to be compressed for this quarter and going forward. And I think that positive revenue growth we see this quarter may have difficulty holding up, because revenues have been growing because of pricing power. And as inflation continues to moderate, companies may lose their pricing power.
Sarah, what about credit? There's a lot of talk about a credit crunch, whatever that means. Certainly there's tightening credit, it appears. Is that more likely to slow down the economy, Sarah?
I think it is, because the consumer and the employment market has been what is holding up the economy here. And with the mini banking crisis that we saw, we expect banks to tighten credit, and that'll make it tougher for the consumer. And just thinking about banks more broadly, they're going to probably have issues going forward with tighter regulations, tighter capital requirements, and pressures on their net interest margins, even though we saw today with JP Morgan an unusually positive net interest margin, net interest income for them. But I think that was unusual and will normalize to the downside going forward.
So I think that a lot of it depends on how much credit conditions tighten. And I think there's a big difference between what's happening with regional banks and what's going to happen with the major national banks. What I hear from my contacts at the big banks is that we are not tightening credit conditions, but what we are doing is adhering more closely to our own lending standards. So a very mild tightening of credit conditions, whereas the regional banks, some have been under pressure and conditions are going to tighten significantly. So then the question becomes, what is the impact on the economy? I think that it's certainly going to be a negative, a source of negative pressure, but at the same time, I also believe it could be a positive in that the Fed sees that some of its work is being done for it by those tightening credit conditions, and then, of course, decides not to hike rates any further.
Exactly. What about that, Sarah? Are the credit conditions actually doing the Fed's job for it? Does it make it less likely it will actually have to have one and done?
I think credit conditions did some of the Fed's job in March. A couple of weeks before the March Fed rate hike, markets were expecting 50 basis points. The banking crisis took 25 basis points off of that, and we just got 25 going forward. I agree with Kristina. Regional banks are more at risk than larger banks, but these large deposit flows that we've seen come from regionals to large money center banks likely moderates from here, and we probably even see some attrition from that going forward. And then the larger banks also have these capital markets businesses that are down significantly, which is going to be an issue going forward. In the larger bank category, we'd stick with diversified companies like Morgan Stanley because of their strong wealth management business, or ING. But generally, we're not positive on banks overall because of the structural issues they're going to have going forward, which started over a year ago.
And that is exactly where we're going to turn next, where we should be putting our money given this uncertainty. Saira Malik of Nuveen and Kristina Hooper will be staying with us as we get some investment advice from them in these uncertain markets. That's next on Wall Street Week, and we are on Bloomberg.
Inflation in America. It's a problem that has come and gone every time but this one. Inflation previously was strictly a wartime phenomenon, starting with the period during and after the Revolution and returning virulently, even more virulently than lately, at the time of the Civil War and World War I. What was different was that periods of deflation always followed. Indeed, the compound annual rate of U.S. inflation since 1790 works out to only 1.2%. What's different about inflation in the last 40 years is not its height, but its length.
That was Louis Rukeyser on Wall Street Week back in January of 1981, another time when inflation was proving harder to get under control than markets would have liked. The top movie back then, that week at least, was The Incredible Shrinking Woman, starring Lily Tomlin and directed by Joel Schumacher. And the #1 song, well, that was Starting Over by John Lennon. Still with us are Kristina Hooper of Invesco and Saira Malik of Nuveen. So, Kristina, let's start with you. Given that what we're having with inflation, trying to get under control, what the Fed is doing, what does that tell investors? What should they be doing right now?
So, David, what I think is it's telling investors right now is that there is an awful lot of uncertainty out there. We don't know what the Fed's going to do. Sarah and I differed in what we expect, and I think that's very, very true. Markets don't know what the Fed is going to do. And in addition, what we have is this big unknown about the debt ceiling. And will it be easily resolved, or will it be a problem like it was in 2011? And could it be even worse than what we saw in 2011? So this is an environment that I think you want to be defensively positioned in tactically, though, waiting for a change. And what is that change going to be? Well, to make sure the banking crisis is behind us, and also, of course, making sure the Fed hits the pause button and we are poised. That, to me, means we'll be poised for a different market environment, one that tends to be more risk on.
Kristina, when you say defensively, I think cash. Money markets are returning some pretty nice returns right now. Are you talking cash?
I am not talking cash. I'm talking about within equities being more defensively positioned in terms of technology, healthcare, consumer staples, utilities. Within fixed income, being more cautious, having investment grade credit. So within alternatives, overweighting gold and underweighting cyclical commodities. So that to me is being defensively positioned, but also recognizing that this market regime could turn soon if we get that pause and if we get more clear signs that the banking crisis is behind us.
So, Saira, you're a chief investment officer at Nuveen. Where are you putting your money?
We're advising our clients. Overall, our theme is quality, making sure you own companies that are resilient and can survive lower earnings and a recession. So starting with equities, dividend growers. These companies tend to increase their dividend over time, so it gives clients income. And also, they tend to have strong balance sheets and strong free cash flow because they're able to grow their dividends. Surprisingly, we also like emerging markets. That's an area that we don't think of as sort of low beta, but with China reopening and the dollar likely weakening as the economy slows in the U.S. and valuations on their side, we like emerging markets for a little more bang for your buck. In fixed income, we're looking at high quality, high yield, again, the quality theme, and also BB rated corporates where you can reach for yield and get a little stronger return. And then real assets are interesting. Our top pick coming into this year was infrastructure. The components of that are waste management and utilities. Even during a recession, we take out our garbage and we still turn on our lights, so that tends to be a recession resilient sector going forward. Those are the areas that we like across the board.
So, Saira, just to press you a little bit, do you have any good examples of what you call dividend growers?
Sure. So it's across the board. It's not growth versus value. A company like Linde, which is an industrial gas company, they tend to have strong margins, strong pricing power, high quality company, and nice yield. These are the companies that we like going. Morgan Stanley is another company. We just talked about that within financials. That's our, the company we like in a sector where we're not as positive on, but they have a nice dividend yield. All these companies that have a nice yield and also tend to increase their dividend going forward are companies that fall into the dividend grower category.
So, Kristina, there's a lot of talk about earnings recession right now. Some people even think we're already in one. Do you anticipate an earnings recession? And if you do, what does that tell you as an investor? What should you do about it?
Well, I think there definitely will be an earnings downturn. I mean, that has to happen just given that the U.S. economy is under pressure. I don't know if it'll be a technical earnings recession, but it really doesn't matter because as we know, markets tend to discount out 9 to 12 months. And we also know that historically, when rates go down, that's a period in which we see multiple expansion. So I think that will be a countervailing force to the downward pressure exerted on stocks because earnings are disappointing in the next several quarters.
So, Saira, let me come back with a version of the question I asked Kristina. That is to say, if in fact we think there's going to be a downturn in the earnings, we've already seen some of that already, should you really be in cash, you can come in and buy it at the right time?
So cash is interesting in the sense that we do acknowledge that it is paying a reasonably high interest rate right now. The issue with holding cash is trying to time the market to get back in. So for example, over the last 30 years, if you missed the 10 and 20 and or 20 best days, you'd underperform the benchmark by about 50 to 73%. And that's the issue. We saw it during the pandemic where the market bottomed in March 2020. I don't think anybody thought that would be the bottom, and then it was off to the races from there. So our view is more that you want to own quality, average back into the market. Just stepping back, you mentioned an earnings recession. I think we're already in one. This is going to be the second quarter of negative year-over-year earnings growth, which is an earnings recession. What we're worried about with earnings going forward is, of course, that revenue growth, which is expected to be about 2% this quarter. I think it's going to be tough for companies to hold on to that because of their inability to hold on to pricing power and the economic slowdown.
Quickly here at the end, Kristina, what about that? Should investors be afraid of missing out? Should this be a FOMO time because they're worried if they're out of the market, they can't get back in?
Absolutely. The hardest thing about investing is market timing. So I think it's always better to be strategic, well diversified, and just enjoy the ride.
Okay, this has been a terrific discussion. Thank you so much for being back with us. That's Saira Malik. She's CIO of Nuveen, and Kristina Hooper of Invesco. Coming up, the rumbles sent through the banking sector by the failure of Silicon Valley Bank and others. We're going to go through the obvious and maybe what may not be quite so obvious with Glenn Hubbard of the Columbia Business School. That's coming up next on Wall Street Week, and we are on Bloomberg. This is Wall Street Week. I'm David Weston. As we enter banks' earnings season, investors are paying close attention to evidence of continuing effects of the failure of Silicon Valley Bank and government intervention to protect depositors. To take us through the likely effects, we welcome back now Glenn Hubbard. He's Dean Emeritus and Professor of Finance and Economics at Columbia Business School. Dr. Hubbard, of course, served as chair of the Council of Economic Advisors under President George W. Bush. So, Glenn, thank you so much for being back with us. So we've paid a lot of attention to what's going on with banks, particularly regional banks, what's happened here. What are the obvious effects, and what are maybe some of the more subtle ones we may be missing?
Well, great question. An obvious effect is you're seeing deposits move from smaller and regional banks into money center banks. You're seeing a lot of questioning of the financial health of many regional banks and a lot of concerns about where the line is drawn in deposit insurance. We're sort of at the worst spot now where we don't know, will it be expanded a lot? Is it going back to where it was? But to me, there's some less obvious but bigger issues having to do with a credit crunch. You know, a lot of commercial real estate lending, a lot of commercial and industrial loans, certainly in the heartland of the country, are made by small and regional banks. And so even if depositors are safe, the credit crunch may provide quite an impact on the economy and on the Fed's job.
What could the possible effects be on the real economy, if I can call it that? I mean, we all care about banks, regional banks. We don't want to wish them ill. But could there be broader ramifications for the economy overall?
Well, of course, if banks are tightening lending because they really don't see good things to which to lend, that's certainly fine. But if banks are very worried now about the loss of deposits, no one wants to be the next Silicon Valley Bank, or fears of needing more capital, and then constrict loans and real estate projects can't happen, small and mid-sized businesses can't get loans, that becomes a quite large effect on the economy. From the Fed's perspective, that's like thinking there's some extra rate hikes happening in addition to the ones that the Fed is doing. And so the credit crunch may well crimp activity going forward, although it will help the Fed bring down inflation.
So let's go back to your question about deposit insurance and where we are on that, because we have some people like Bob Diamond, for example, formerly of Barclays, saying we should at least insure up to $1 million of deposits, maybe have unlimited. If you were back in your old job advising the President of the United States, what's the right answer for the banking system and therefore for the economy overall? What would you advise him? What do we really need from our banks?
I would say let's start with what can't be right. The current law wasn't right. The limit was too small to deal with the modern economy, and the Treasury or the Fed would try to move to increase it whenever we get into trouble. So that's not good. Unlimited, I don't think, is a very good idea. That takes away any incentive for depositors, even a very large size, to monitor the bank. And where to draw the line is hard, because what you would want in principle is the payrolls of small and mid-sized businesses, individuals' transactions accounts to be okay, but those could be large numbers. Here's the concern. The higher we take that limit, the more we push for more regulation of banks. It's not going to be the case that the taxpayers insure all deposits in the country without changing what banks do. And going to our earlier conversation just a moment ago, banks are very important in lending in some activities. So I think we need a more fundamental conversation about what do we want banks to do and how are small and mid-sized businesses and real estate going to get credit.
So, Glenn, one of the things that maybe goes unsaid largely is sort of a desire to preserve regional and specialist banks across the country. We have something like 4,500, I think, right now, banks across the country. Is that too many? Can I ask that blunt question?
Well, I think we've always had too many banks in the United States, certainly relative to any of our peers. That said, while I don't know that we have a policy objective of preserving particular community or regional banks, we do want to preserve the lending activities there. So I don't think it's the case that if all deposits in the United States suddenly moved to the 4 largest banks, that we'd have the same mix of lending. That's what I meant by we really need to step back, we, thinking of the Fed or even the Congress, as to what we want banks to do. But we're on an unhealthy path now of playing with deposit insurance without thinking about the future.
Let's talk about some of the things that could really affect banks and the economy more generally, and that is the debt ceiling. A lot of talk about that now. We're going to have the Speaker of the House come to the New York Stock Exchange next week to address the question as part of a discussion of the overall economy. Where are we in the debt ceiling, and where are we in this discussion back and forth between raising the debt ceiling and curtailing spending?
Well, it's a great question. I mean, certainly we shouldn't default on the debt. So no conversation should end there or even get close to there. But the debt ceiling discussion is a source of rare leverage in Washington to at least talk about spending. The administration and the Congress do both need to put their cards on the table, both about near-term spending, like getting unspent COVID funds back or addressing the growth in discretionary fiscal policy in recent years, and have a serious conversation about long-term spending. If it takes the debt ceiling to have it, so be it.
It also strikes me, but you've spent more time in Washington than I have, Glenn. It takes some political courage to talk about cutting spending. It's fine in the abstract to say we've got to curtail spending, but when you get down to brass tacks and say we're going to cut that program, somebody's ox is being gored. Who has the political courage to do that, Democrats or Republicans?
Well, neither, apparently, but I do think there's a different way to frame it. One is to say, look, unspent COVID funds, they need to go back to the Treasury. We've had a big growth in spending in the past several years. Do we really believe that's necessary going forward? That should be not a lot of courage to say those things. As to the bigger problems in Social Security and Medicare, I think the real issue is being honest that we want to preserve these programs. And to preserve these programs, we have to address their structure. That probably starts with a commission or some sort of discussion going forward, but it shouldn't take that much courage to at least get that on the table in this budget negotiation.
That would be nice if it doesn't take much courage. How much time does it take? Because we have these trust funds that I think are running out, are they not?
They are. The Medicare Trust Fund will be out in just a few years, Social Security by about 2033. Economists would say that doesn't really matter. These programs are in bad shape yesterday, today, tomorrow. But it may be an action-forcing event in Washington. We shouldn't wait that long. The longer we wait for either Medicare or Social Security, the harder the solution is on benefits and taxes. There's no time like the present, but I'm not sensing a lot of support for that idea in Washington.
Well, is the idea fleshed out? Is there a think tank, or is there part of some party or some leadership in Washington who are coming up with plans that you're looking at and say, you know what, that's a smart way to do it?
Well, you know, both parties have over the years. If you turn back the clock to the previous budget brouhahas in the early 2010s, the debt ceiling battle, there was also a Bowles-Simpson commission that had interesting ideas from both political parties. Over time, people have had this discussion. We need to have it again, and we need to have it now.
Yeah, Bowles-Simpson, whatever happened to that commission? What happened to that report? I don't remember anything happening other than it getting published.
Absolutely nothing happened. But I think here we've got the action-forcing events of the trust fund issues and the public knowing that something is wrong, that spending has accelerated a lot during the pandemic with no break.
Glenn, thank you so much. It's always a pleasure to have you with us. Glenn Hubbard of Columbia Business School. Coming up, higher rates are turning up the heat on so-called zombie companies. We'll talk about the size of the problem with Sonja Gibbs. She's from the Institute of International Finance. That's coming up next on Wall Street Week, and we are on Bloomberg. It was nice while it lasted. All those low interest rates and all that government stimulus gave the markets and the companies they represent a nice run up.
The stimulus that came in during COVID has meant that we've had very, very robust balance sheets, both kind of corporate and institutional as well as personal.
But now the time has come to pay the piper as rates move up faster than we could have imagined.
Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground. and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do.
Putting real pressure on companies and markets, something Nobel Prize economist Michael Spence says is pretty much to be expected.
We're having an asset price reset. Part of that is just a function of sort of overvaluations, and so we shouldn't worry about that. It's just going to happen. There'll be a little pain associated with it, but it's not fatal.
But what may not be fatal to the economy overall may do real damage to some along the way, particularly the so-called zombie companies that don't generate enough cash to cover their debt payments, which Rashir Sharma from Rockefeller International says is a real and a growing problem.
That is the contradiction here, which is that we do not want any pain, and that's completely justified, and we want the government to come to the rescue, but we also don't like the economic outcome.
And to take us through the wild world of zombie companies, we welcome back now Sonja Gibbs. She was with us back in August and told us about zombie companies. Sonja is at the head of sustainable finance at the Institute for International Finance. Sonja, welcome back. Back in August, when you were on Wall Street Week, I went back and checked. The federal funds rate was 250 basis points lower than it is right now. At the time, we talked about the extent to which low rates really created these companies that can't afford to pay the debt that they've incurred. Has the problem gotten better because interest rates are so much higher?
Well, I think maybe you should think of it in terms of medicine. Sometimes the medicine that you need to correct a condition really may taste awful and may make you feel ill for a short time before you get better. And this is the way it is with higher interest rates. Certainly we need higher interest rates. You can't maintain forever a period of ultra-low rates, and central banks around the world are addressing that issue. So over the longer term, it's going to correct the problem of too easy access to capital, too much debt, and so on. In the short term, though, higher rates are going to cause a lot of pain, and particularly for the kinds of companies that we've been talking about, these zombie firms whose earnings are not sufficient even to cover their debt service, let alone investment and operating costs. That's why we call them zombies. They're on borrowed time.
Well, and how long is that time? Do we have any sense of how long it takes? Because presumably they're going to have to renegotiate some of the debt as it comes due. It's going to be more expensive when they renegotiate, which just makes their situation worse.
Well, I think the difficulty is now we're heading into a period of slower economic growth while interest rates are continuing to move higher. So you have a tightening of what they call financial conditions. So access to capital is just getting a lot more difficult. So the next 6 months to a year are going to be very challenging in terms of making sure that companies can service their debt and that companies around the world, and especially small companies, which tend to have a harder time accessing capital in any case, can raise the funds they need to support jobs and growth and keep the economy humming along. So it's a challenging period over the next year or so.
So when companies do have to renegotiate their debt, do you expect it will be a problem of how much they have to pay on the interest on the new debt? Or is it possible some credit just won't be available at all? I mean, people are talking about a possible credit crunch, in part because of the problems we have with the banks here, in which case you couldn't get the credit no matter how much you're willing to pay for it.
I think there will be some instances like that. So the borrowing prospects of some firms have really tightened quite a bit. And the problem with higher interest rates is that there are ripple effects across all kinds of credit provisions. So, for example, you're also seeing tighter access to different forms of equity capital, to venture capital. So conditions in all kinds of ways to raise funds are not as good as they were even a year ago. Mostly, though, it's going to be a question of adapting to the higher cost of capital. So adjusting your plans. Maybe you'll have to scale back investment. Maybe you will have to not do that new hire that you wanted to make. So all of these things together create a rather challenging environment at a time when earnings prospects are already dimming in many parts of the world.
We've had interest rates relatively low around much of the world. How much of this is a U.S.-specific problem? How much of it do we see in other countries around the world?
No, you see it everywhere. And I think the particular challenge is for a number of emerging and developing economies, which are facing a perfect storm of difficult conditions. So a slowdown in major economies, a tightening in global capital markets, harder for them to access international markets to borrow, and also factors that still stem from the aftermath of the pandemic. So you have social issues, you have healthcare issues, you have climate vulnerabilities as well, which are becoming more and more apparent around the world, and particularly in many emerging and developing economies, which is a subject of discussion here in Washington, D.C. at the IMF World Bank spring meetings this week.
We'll talk about those meetings specifically, because I'm mindful of the fact that it's not just private enterprises that could really have too much debt to service. We also have a number of countries, particularly middle and lower income countries. There's a lot of negotiation going on this week about what's to be done about that. Give us a sense about the sovereign debt situations. It's not a zombie country, but nonetheless, it's a problem not being able to service their debt.
The goal here is to bring all of these, which might call stakeholders, together and find out a way to restructure sovereign debt when it has to happen. This process can be very drawn out, very long, and that makes it difficult for a borrowing country to get back on its feet again. So if we can speed up this process, and it's very helpful in this regard that China, who's a very large creditor for a number of low-income and developing economies, China is also present in these discussions at this new Global Sovereign Debt Roundtable, and it's very encouraging to see the constructive dialogue and suggestions for improvement in this process.
This is not a pleasant situation for the countries and the companies that owe more debt than they can service. But how does it affect the rest of us, particularly in terms of growth? You mentioned earlier for some of the smaller companies in the United States, they have to change how they allocate their capital, how they use their funds if they're really choking on the debt.
No, I think that's a very good point, and often underappreciated, that in most economies around the world, it is the small and medium-sized enterprises, the SMEs, that are the engine of growth for the economy. And if those firms are having a harder time accessing capital, and the challenge is there's contagion, as it were, right? Because financial conditions and cost of borrowing aren't just getting worse for companies that have too much debt. They're getting worse across the board. So even for a healthy company, it may be a bit harder to get capital on as attractive terms as it was, a year or two ago.
Sonja, you study these things carefully. Is there also an opportunity cost to this? That is to say, if a lot of that capital is getting consumed in ways that are not very productive, there may be other entrepreneurs out there who'd like to get started, like to ramp up, and they can't because they can't get access to the capital.
I think that's right. I mean, think about the uses that firms have for capital, right? Some of it is for investment in new plant or machinery. Some of it is for hiring. But a chunk of it has to go for debt service. So when you think about it, it's a limited pie. And if you have to give a much bigger slice of it to service your debt, that's an opportunity cost. You can't use that capital for other sources. And it's also true, as you say, that if you're a small startup firm looking to enter the market and raise capital, and if established competitors, if other firms are already trying to tap the markets at the same time, then it's kind of a fight for capital, and you might even call that a credit crunch. And indeed, it's becoming increasingly clear that we may be already in a credit crunch.
Sonja, thank you so much for being back on Wall Street Week. That is Sonja Gibbs. She is with the Institute for International Finance. Coming up, we wrap up the week once again with our very special contributor, Larry Summers of Harvard. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David West, and we're joined once again by our very special contributor here on Wall Street Week. He is Larry Summers of Harvard. Larry, great to have you with us again. Tell us where you think the economy is right now. We got a raft of eco numbers in, CPI and others this week, that some people interpret as indicating that maybe actually the Fed is having its way, that the economy is softening, inflation is coming back down.
I think it's very hard to read, David, but I think I see some growing evidence of stag, but some real continuing concern about inflation as well, and that's a tough combination. On the stag side, it does look like defaults are rising. It does look like the flow of credit is coming down. Headline retail sales were not strong, although the internals are less clear. So I think you have some grounds for concern about what's happening with real activity on a forward-looking basis. And while the CPI and the PPI numbers surprised a bit in a favorable direction, you saw one-year inflation expectations from the University of Michigan pop up, and the Atlanta Fed wage tracker, which I actually think is a better indicator of what's happening in the labor market than the monthly average hourly earnings, that popped up a bit last month as well. So I think we're still looking at a very hard to read economy. I don't see inflation as on a secure path down to the 2% target unless the economy turns over a bit. So I think the Fed has very difficult choices ahead of it.
So, Larry, let me make it even more complex, perhaps, and that is where we are with credit right now. There's a lot of reports right now that credit standards are going up in the wake of those bank, if I can call them tremors, that we had. How do you factor that into it? Could that help the Fed a bit, really curtail some of the inflation?
Look, I don't think there's any question, David, but that some Fed work is being done by tightening of credit. So there's definitely that effect. The question is, how large is it? I thought prior to the tremors in the banking system that there was a chance the Fed funds rate would have to get up to 6, and that it was certainly more likely than not that it would have to get to 550. What's very hard to know is whether that action in credit, which is reinforcing the Fed, whether that's 3 moves worth of reinforcement, whether it's only 1 move worth of reinforcement. And that's the judgment the Fed's going to have to make on an ongoing basis. I'm surprised still that markets are expecting as large a set of rate cuts over the next 2 years as is currently priced in, because it seems to me that we're not very likely to get 6 or 8 rate cuts over the next 2 years unless the economy is headed towards recession. And certainly recession of a substantial sort is not what's priced into the stock market or, for the most part, priced into high-yield credit.
Larry, let's talk about something we haven't talked about that much, which is oil. There was reporting by Bloomberg this week that really suggested there is something of a rift growing between the United States and Saudi Arabia, that if anything, Saudi Arabia is getting closer to President Putin in Russia. And the question is, what does that do potentially for the price of oil and therefore at least headline inflation? How big a problem do you think this is potentially?
Look, I think what's happening in the Middle East, and it's the Saudi Russian thing that you just referred to. It's the Chinese brokered restoration of diplomatic relations between Saudi and Iran is a symbol of something that I think is a huge challenge for the United States. We are on the right side of history with our commitment to democracy, with our resistance to aggression in Russia. We are very much on the right side of history, but it's looking a bit lonely.
Larry, I know you spent the week at those meetings, the IMF and the World Bank in Washington, D.C. What did you see, what did you hear about that very subject? That is, the extent to which maybe we may be breaking up into, if I can call this, trading blocks, where people trade with one another, but actually we're moving away from globalization. We're not necessarily all on the same page.
I think there's a growing acceptance of fragmentation, and maybe even more troubling, I think there's a growing sense that ours may not be the best fragment to be associated with. Somebody from a developing country said to me, what we get from China is an airport. What we get from the United States is a lecture. We like your values better than we like theirs, but we like airports more than we like lectures. And so I think that what's at stake in some of these really technical discussions that they're always having here about debt relief or about the future of the World Bank is not just a bunch of stuff about lending money to promote different economic activities or to make development more sustainable, but what the broad structure of the system is going to be. And if the Bretton Woods system is not delivering strongly around the world, there are going to be serious challenges and proposed alternatives.
Larry, your name came up actually in connection with these meetings as people noted that the IMF is really having a different projection on long-term interest rates, particularly the neutral rate over the longer term, saying it's going to come right back down to pre-pandemic levels, whereas you have been saying that's not necessarily the case. Where are you on that issue?
Look, I was, in a way, glad that the IMF was resurrecting and talking about the secular stagnation theory that I pushed so hard between 2013 and 2019. And certainly I recognized all the various arguments they were making, and it's certainly possible that they will turn out to be right. My own sense is that given the huge volumes of government debt that have been run up, given the very large flow deficits that are in offing, and given the large amounts of private investment that are going to be devoted to the renewable energy transition and devoted to friendshoring and increasing resilience, my sense is that the balance in the supply and demand for funds is going to be more towards demand, and that's going to mean higher real interest rates going forward than we had before the pandemic. And so I'm not expecting that we will see a huge return to the secular stagnation situation.
Larry, in your opinion, how does money supply figure into your analysis of the economy overall? There was a lot of talk this week by some economists actually saying that, in fact, the fall in the money supply, particularly M2 with respect to the United States, really indicates that, in fact, we're going to go, if anything, into a recession, that we're not going to have to worry about inflation anymore.
David, I would describe myself as post-monetarist. I think when we started paying interest on reserves, and so if a bank or somebody had an account at the Fed, it was kind of just like a interest-bearing account. And so money was no longer special by virtue of not paying interest. When we had that change in our economy, I think this whole concept of monetary aggregates as substantial predictors of what's going to happen lost a lot of its force. And so I'd have to say that money stock is pretty far down on my list of indicators to follow.
Larry, we'd like to do a few long-short analyses here for you, and let's take a few of those right now. First of all, having come from the IMF and the World Bank, are you long or short on the global economy overall? Janet Yellen seemed to suggest it's in better shape than we thought. At the same time, some people from the IMF were saying that we think it's pretty shaky.
I'm probably closer to the IMF, but it depends a lot on how lucky we are. It depends a lot on the choices that are made in the next 6 months.
And Larry, sticking with the IMF for a moment, if we could, you mentioned before sovereign debt relief. I know that was a big topic of conversation for you all in Washington. Are you long short on meaningful sovereign debt relief for the poorest countries?
Short in the short run, long in the long run. It will come, but these things always take time.
Okay, and finally, let's turn to football. We usually talk about golf, but football in Washington, where you've been this week, we have the Washington Commanders now going for a record price of $6 billion to a syndicate led by a co-founder, actually, of Apollo. Are you long short Washington professional football?
I've spent enough time in Washington to have some loyalty to the Washington Football Club, now known as the Commanders. I think this is an important moment for rejuvenation and renewal, and I wish Josh and his colleagues the best.
Okay. Thank you so much, Larry. Always great to have you with us. Our very special contributor to Wall Street Week, he's Larry Summers of Harvard. This is Wall Street Week on Bloomberg. Finally, one more thought. Longing for the good old days. Change is hard. Just when we think we have things figured out, the world goes and changes on us. Take inflation. After Chairman Volcker administered his harsh medicine of rate hikes,
a much tougher approach to inflation, which led to nearly 20% official interest rates. Hard to believe now, hard to remember, at a time when inflation was also in the high double digits.
We thought we'd left that problem behind us. We even fought to get some inflation back into the system.
It was a big thing to start this rate increases. I think the fact that they have them to 4 3/4 to 5% now, they'll be a little bit higher probably before they go on pause. And I think if inflation is around 3% plus or minus, they'll be pretty pleased.
But that all changed last year when that stimulus finally kicked in and reminded us of the bad old days.
We are seeing inflation coming down. It's come down by about 45% since the peak, but we still have more work to do.
But it's not just inflation that has shifted on us. What about all those banks that thought there was nothing safer than long-term treasuries as investments?
The basic issue that, they took all of these big deposits and invested them in long-term treasuries and had a gigantic mismatch where, again, it should never have occurred.
Now it turns out that what was a safe haven has turned into a lot of unrealized losses on balance sheets.
You have this bank that has deposits from very concentrated, highly volatile depositors, and you have a balance sheet where they've invested long in treasuries, and when interest rates spike, they're underwater.
This week, we were reminded that it's not just economics and banking where we have our expectations shaken to their core. Now we hear that Tupperware, that iconic plastic system for keeping food fresh,
plan to have or attend the Tupperware party soon,
may be going out of business.
Shares of Tupperware falling 50%, the most since 2020, after the company said that it hired financial advisors to help improve its capital structure and its ability to even stay in business.
The company dates back to 1946 when Earl Tupper, yes, there was indeed a Mr. Tupper, developed it in Leominster, Massachusetts. Part of its claim to fame was the way it was sold, in Tupperware parties thrown at homes by women looking for a new way to make a living after men came back from the war and took all their jobs back. But however things work out for Tupperware, there are times when change is actually for the better. Take the iPhone, something that some of us have grown all too attached to. So attached that we may have forgotten what came before. The BlackBerry, which we don't miss all that much, no matter how iconic and cool we tried to make it at the time.
We wear cool suits, we wear shiny shoes, we're the BlackBerry Boys.
That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.